Today, Sidra Capital is doing just that, launching a groundbreaking mutual fund focused on energy and mining loans down under. Ready to discover how you can ride this wave? What's up, TJ Crypto World community? I'm TJ, your insider guide to the most powerful investment opportunities in the crypto and alternative finance space. On this channel, we break down cutting-edge strategies so you can move first and profit most. If that's you, smash subscribe and hit the bell. Today we're dissecting Sidra Capital's ambitious push into the Australian private credit market. In this video, you'll learn why Australia's private credit sector is a hidden goldmine, how Sidra Capital's new mutual fund gives you access to energy and mining loans, the risk-reward profile and expected returns over the next 3 to 5 years, regulatory and operational considerations, how Sidra navigates ASIC rules. Stay until the end. I'll share a pro tip on positioning your portfolio to maximize tax efficiency in this fund. 1. Australia's burgeoning private credit universe. While public debt markets grab headlines, Australia's private credit sector quietly commands over $500 billion Australian dollars in deal flow, financing mid-sized energy projects, mining expansions, and infrastructure builds. Traditional banks, hamstrung by Basel III capital constraints, have ceded ground to alternative lenders. That's where Sidra Capital sees opportunity. Private credit means direct loans to companies, often at attractive yields of 7 to 9% per annum, secured by project revenues or asset pledges. For investors, it's a way to diversify away from volatile equities and low-yield bonds, while still tapping corporate credit spreads. 2. Sidra Capital's mutual fund structure. Sidra Capital is launching the Sidra Australian Private Credit Fund, a retail-accessible vehicle structured as a regulated mutual fund under ASIC rules. Key features: minimum investment, $25,000 Australian dollars, lower than most private credit plays. Quarterly liquidity windows, balance between access and capital lock-in. Targeted yield, 8 to 10% net, with quarterly distributions in AUD. Diversification, across 20 to 25 loans, 60% energy sector, 40% mining services and equipment. This setup democratizes what was once institutional turf, giving high net worth and family office investors a transparent, professionally managed entry point. 3. Focus on energy and mining loans. Why energy and mining? Australia's natural resources boom shows no signs of slowing. Renewable energy, financing solar farms, battery storage, and wind projects, backed by government PPA guarantees. Hydrogen ventures, loans to green hydrogen startups, positioning Australia as a decarbonisation hub. Mining services, equipment leasing and working capital finance for Tier 2 miners supplying copper, lithium, and gold. Sidra Capital's credit team performs rigorous due diligence, site visits, cash flow modeling, environmental audits, to ensure each loan has robust collateral and repayment covenants. If you're excited about tapping into Australia's resource-driven private credit market, hit like and subscribe to TJ Crypto World. Drop a comment below if you've already explored private credit or want more fund breakdowns. ASIC licensing. Sidra holds an Australian Financial Services Licence, AFSL, allowing it to offer managed investment schemes. Custody and compliance. Loans are held by an independent custodian, and the fund undergoes quarterly audits by Big Four firms. Investor protections. A detailed product disclosure statement lays out risks, fees, and liquidity terms, no hidden surprises. By proactively embracing compliance, Sidra Capital gives investors peace of mind that their capital is managed by a credible, regulated entity. 5. Risk management and due diligence. High yields come with credit risk, so Sidra employs a multi-layered risk framework, sector caps, no more than 60% exposure to any single industry. Borrower limits. Maximum 5% of fund assets to one borrower. Covenant monitoring, ongoing surveillance of borrower financials, with trigger events for early repayment or collateral top-up. Climate and ESG screens, excluding high-emission coal projects and enforcing environmental safeguards. This disciplined approach aims to preserve investor capital while capturing income opportunities. 6. Expected returns and timeline. Year 1 to 2. Establishing loan book, target 8% net returns. Year 3 to 5. Portfolio seasoning and refinancings could lift yields toward 9 to 10%. Beyond, potential to expand into infrastructure credit, toll roads, ports, and telecom towers, driving further diversification. For investors seeking stable cash yields uncorrelated with equities, this fund could become a cornerstone holding. Sidra Capital's leap into Australia's private credit market is more than a geographic expansion. It's a strategic bid to offer high-yield, low-volatility income streams in energy and mining finance. Through a regulated mutual fund structure, rigorous risk controls, and seasoned sector expertise, Sidra aims to unlock a new asset class for retail and institutional investors alike. Review the fund's product disclosure statement on sidracapital.com. Assess your portfolio's allocation to private credit, target 5 to 10%. Contact your financial advisor for suitability and tax considerations, especially for non-resident investors. If you're ready to diversify into Australia's private credit boom, tap like, subscribe, and ring the bell for updates on Sidra Capital's launch. Got questions? Drop them below. Let's discuss strategy. Thanks for tuning in, fund seekers. Until next time, stay strategic, manage risk, and let's capture the returns that institutional investors chase.